Wall Street opened on Wednesday, November 12, 2025, with a surge of optimism that was palpable across the financial district. The mood was noticeably brighter than it had been in weeks, as traders and investors alike sensed a turning point after a period of prolonged uncertainty. The iconic opening bell rang out, echoing through the halls of the New York Stock Exchange, signaling not just the start of a new trading day, but the possibility of a new chapter for the markets. Hopes were high that the historic federal government shutdown, which had cast a shadow over the economy and shaken investor confidence, was finally drawing to a close. News of a potential resolution spread quickly, with headlines flashing across screens in offices and trading floors nationwide. People gathered around televisions and computer monitors, eager for updates and ready to react to any sign of progress. U.S. stock futures responded immediately, jumping sharply as the opening approached. The Dow Jones Industrial Average climbed by 100 points, while the S&P 500 rose 25 points, reflecting renewed confidence among investors. The tech-heavy Nasdaq 100 surged an impressive 165 points, with technology stocks leading the charge. These clear signs of investor enthusiasm suggested that the market was eager for a return to normalcy and stability after weeks of volatility. This rally stood in sharp contrast to the previous day's mixed results, when uncertainty and weak economic data had kept markets in limbo. Traders who had looked anxious just 24 hours earlier now showed cautious optimism, as financial analysts pored over charts and data, searching for signs that the worst was over. The resolution of the shutdown was widely seen as the crucial first step toward restoring stability to both the markets and the broader economy. While some economic concerns lingered, the sense of relief was unmistakable, and the news overshadowed worries about lingering damage from the weeks-long impasse. Investors signaled that reopening the government could spark a powerful, recovery-fueled rally. Many believed that pent-up demand and renewed government spending would help jumpstart growth, providing a much-needed boost to businesses and households alike. The focus quickly shifted away from the political damage of the shutdown and toward the potential for renewed economic growth. Analysts began to speculate about which sectors might benefit most from the rebound and whether the rally could be sustained in the weeks ahead. As sunlight streamed down Wall Street, the mood was one of cautious hope. Investors, traders, and business leaders alike were ready to move forward, betting that the end of the shutdown would mark the beginning of a brighter economic outlook for the country. The record-breaking government shutdown stemmed from a fierce budget standoff between the White House and Congress. Hundreds of thousands of federal workers were furloughed, essential services were slashed, and the ripple effects hit businesses nationwide. The shutdown's economic toll mounted quickly. Critical services halted, paychecks delayed, and confidence shaken. Both parties dug in, turning a budget dispute into a high-stakes political showdown. Temporary funding fixes were rejected, prolonging the crisis. Now, mounting economic pain and public frustration have forced lawmakers back to the table. The cost of gridlock finally outweighed the political benefits. Urgency for compromise is at an all-time high as leaders scramble to end the shutdown. A breakthrough arrived with a bipartisan Senate bill to temporarily fund the government through January 30, 2025. The House, under Republican control, is expected to pass the measure, pressured by public outcry and economic strain. President Trump has signaled support, ready to sign the bill and officially end the shutdown. This stopgap solution buys time for deeper budget negotiations while restoring government operations. Federal workers will return, agencies will reopen, and the backlog of work will begin to clear. The compromise is a classic kick the can down the road, but it's a desperately needed reset. Lawmakers hope this breathing room leads to more productive talks on a long-term budget. For now, the immediate crisis is nearly over, and the nation can start to recover. The recent government shutdown created a blackout of vital economic data, leaving investors, business leaders, and policymakers in the dark. Without the regular flow of information, everyone from Wall Street to Main Street was left guessing about the true state of the economy. This uncertainty rippled through financial markets, causing anxiety and hesitation in decision-making at every level. Agencies like the Bureau of Labor Statistics and the Census Bureau, which are responsible for collecting and publishing critical economic indicators, were forced to halt their reports. This meant that crucial updates on employment, inflation, and growth simply stopped arriving. For weeks, economists and analysts had no way to accurately gauge the economy's true health, making it nearly impossible to spot emerging trends or respond to new challenges. The delayed jobs report is especially critical. This single document reveals the nation's unemployment rate, the number of jobs created or lost, and how wages are changing. These numbers are the foundation for understanding the labor market, and they influence everything from stock prices to government policy. Without this data, businesses can't plan hiring or investments, and families can't make informed decisions about their own finances. The absence of these reports left a massive information gap, fueling widespread uncertainty. Investors were forced to rely on speculation and incomplete data, which increased volatility and made markets more unpredictable. Business leaders hesitated to make big moves, and consumers grew more cautious, unsure of what the future might hold. Other key data on inflation, retail sales, and housing was also frozen. These reports are essential for understanding how prices are changing, how much consumers are spending, and the health of the housing market. Without them, economists and the Federal Reserve were left to make critical decisions with incomplete information, increasing the risk of policy mistakes and misjudgments. Now, with the government reopening, a flood of backlogged reports is about to be released all at once. This sudden surge of information will likely trigger significant market volatility, as investors and analysts scramble to interpret weeks' worth of economic news in a matter of days. The markets could swing wildly as new data reshapes expectations and strategies. A weak jobs report could spook markets and lead to sharp declines, while unexpectedly strong data could spark a rally and restore confidence. The stakes are high, and every new piece of information will be closely scrutinized for clues about the economy's direction. For businesses and households alike, this data is essential for planning, budgeting, and building confidence in the future. Companies rely on these numbers to decide when to hire, invest, or expand. Families use them to make choices about spending, saving, and even career moves. Without reliable data, everyone is left to navigate in the dark. The return of official numbers marks a pivotal moment for the economy. It restores transparency, enables smarter decisions, and helps rebuild trust in the system. As the data begins to flow again, the path forward will become clearer for everyone. The shutdown's data blackout left the Federal Reserve flying blind ahead of its crucial December meeting. With no clear read on jobs or inflation, Fed officials are split on whether to cut rates again or wait for new data. Markets are betting on another rate cut, with odds rising as shutdown damage becomes clearer. The Fed's next move hinges on the soon-to-be-released economic reports. If the data shows resilience, rates may hold. If weakness is revealed, another cut is likely. The upcoming data will shape U.S. monetary policy heading into the new year. Amid the political drama, corporate news is also moving markets. Cisco's earnings, due after the bell, will reveal if AI-driven tech spending is holding up or cooling off. Chevron, fresh off its $55 billion Hess acquisition, will outline its integration plans and future strategy in a key investor update. Both companies' announcements are seen as bellwethers for their sectors, tech and energy, at a time of rapid change. Investors are watching closely for signs of strength, vision, and adaptability. Oil prices dipped Wednesday after a rally fueled by hopes of a government reopening. Brent fell nearly 1% to $64.58 a barrel. WTI dropped 1% to $60.46. The previous day's surge reflected optimism that a functioning government would boost economic activity and fuel demand. But as the initial euphoria faded, traders reassessed the broader supply and demand picture. The shutdown's end removes a key headwind for oil, but global factors, OPEC output, geopolitics, and world growth, still loom large. The market is shifting from knee-jerk optimism to a more measured outlook. Oil's next move will depend on how these complex forces play out. Beyond the headlines, smaller companies are making waves. Oklo, a nuclear startup, edged higher despite a wider loss, as investors focus on its progress toward regulatory milestones, not short-term profits. Advanced Micro Devices soared on upbeat guidance, riding the AI boom and gaining ground on Intel in key chip markets. The broader rally lifted both established and emerging players, highlighting sector trends. AMD's strength underscores the power of the AI narrative, while Oklo's journey shows the risks and rewards of betting on future tech. These stories reveal where investors see the next big opportunities. With the government shutdown finally coming to an end, the focus of investors, analysts, and policymakers now shifts to a backlog of crucial economic data that has been delayed for weeks. The release of this data will be closely scrutinized, as it holds the key to understanding the true state of the economy after a period of uncertainty and disruption. Market participants are eager to see whether the fundamentals have held up, or if there are signs of deeper weakness that could impact future growth. The official signing of the funding bill marks a significant, if temporary, resolution to the political standoff in Washington. This move has provided a measure of relief to both Wall Street and Main Street, but it also raises questions about the durability of the agreement and the potential for future disruptions. Among the upcoming data releases, the jobs report stands out as the main event. Investors and economists alike will be watching closely, as this report will set the tone for financial markets and heavily influence the Federal Reserve's next policy decisions. A strong jobs report could signal resilience in the labor market, while a weak one might suggest that the economy is losing momentum. If the numbers disappoint, recession fears could quickly resurface, putting pressure on the Fed to consider another interest rate cut to support growth. Investors may become more risk-averse, and volatility could return to the markets as uncertainty rises. On the other hand, if the data is robust, it could boost confidence across the board. Strong employment and wage growth would reassure investors that the economy remains on solid footing, potentially fueling a market rally and encouraging businesses to invest and hire. In addition to government data, corporate earnings season is in full swing. Reports from major technology companies like Cisco will be especially important, as they often serve as bellwethers for broader economic trends. Investors will be looking for signs of continued innovation, strong demand, and healthy profit margins to gauge the overall momentum of the economy. Meanwhile, every word from Federal Reserve officials will be dissected for clues about future monetary policy. Their comments on inflation, employment, and economic risks will help shape expectations for interest rates and market direction in the months ahead. However, it's important to remember that the current funding solution is only a temporary fix. The government is funded only through January 30th, 2025, setting up another potential fiscal showdown early next year. As that deadline approaches, investors will be watching Washington closely for signs of progress or renewed gridlock. The risk of another shutdown or political impasse could weigh on sentiment and create fresh uncertainty for markets and the broader economy. In this environment, the end of one crisis simply sets the stage for the next. Investors, businesses, and policymakers alike must remain vigilant, prepared to adapt to rapidly changing conditions and new challenges on the road ahead.